When it comes to retirement planning, accumulating assets is a lot easier than turning those assets into income. This has caused a lot of anxiety among retirees and pre-retirees. It's also caused a lot of anxiety among advisors who really aren't that well equipped to advise their clients on the process of turning assets accumulated into income distributable. Now, I've always argued that the best approach to planning out the process of turning assets into income is a strategy that starts earlier rather than later. But I do realize not everyone has the luxury of that position. And today, I want to highlight the role annuities might play in generating retirement income for you. We're going to walk through an example of a real life situation, somebody who came to us about 9 years ago and asked us for our advice on a rollover and what their options might be with the money for the purpose of retirement planning. Okay, so to start, we'll set the stage. Individuals in their mid-50s and was looking to roll money from a qualified retirement plan into an IRA. The sole purpose of the money was to prepare for retirement. So eventually this would be used as a means to create income in retirement. We looked at a number of different scenarios as we normally do. First, one of the most obvious and frankly easiest things to model was to look at what might happen if the money just went into the market in a passive indexed investment strategy. So modeling as most people would do, using an 8% rate of return each year, looking at what the account balance might be at our targeted date in the future, which for this individual happened to be somewhere in the neighborhood of 8 to 10 years. We could then look at the account balance and take a withdrawal percentage from that to decide what might be a safe withdrawal rate from this hypothetical or rather speculated accumulation of assets. And in this particular scenario, that income number turned out to be $3,850 per month speculated at the 9-year mark. That wasn't bad, and that was certainly going to be good at covering the basis. It was going to take care of the expenses that this individual was pretty sure were going to be fixed and around forever and always. In fact, it was in excess of what they assumed would be the case for them 9 years from that day. Alternatively, we looked at annuities, and we went to the fixed index annuity space because this was about 2015 when the variable annuity income features were really not looking so great. There were a number of big players that had exited the market. The one that stuck around the longest ended up in a bunch of mess that resulted in significant changes in how they did business as a company. So we knew that if we were going to look at annuities, we were probably going to have to stick with income features, guaranteed withdrawal benefit features that accumulated on fixed indexed annuities because those were the strongest. For those who don't know, these style products allow you to accumulate a benefit for the sole purpose of generating a guaranteed withdrawal amount year over year from the annuity. It's not the same as annuitization, where you turn the annuity into an income stream and forsake all of its cash value. This is a different functionality of annuities where you will still maintain cash value. However, if you want to access any of that, you will most likely forfeit at least some of your withdrawal benefit that you are guaranteed for life. In this situation, it happened to be the case that the guaranteed withdrawal benefit that this individual could acquire was $3,980 per month. So a modest, but still higher amount than the hypothetical modeling from an S&P 500 index investment. At the time, the logic that we approached this with, and the individual was pretty on board with this thought process, was, well, if we think the market can do that, but we know the annuity can do this, why not go with the annuity and have a sure bet? And that's exactly what we did. Interestingly, though, we now have the advantage of hindsight. We can go back and see what actually happened. Well, it turns out that from inception to now, the market went through a pretty fantastic booming period, and the S&P 500 ultimately did better than an 8% annual rate of return year over year. And it turns out, had this individual taken the money and put it in something like an S&P 500 index fund, like the SPY, for example, the resulting balance probably would support an income amount of about $5,200 per month. That's obviously higher than the $3,980 per month we were expecting from the annuity. But there are a couple of things. One, we didn't know this was going to happen. And two, there would have been some moments throughout these past 9 years that would have absolutely tested the faith that one might have in staying the course on a market-style investment. In 2020, for example, January 1st to March 31st, the account balance would have dropped by about $200,000. I assure you, that was a relatively large percentage of the account. And that would have caused some serious hand-wringing with respect to should we keep going with this or should we sell to mitigate loss. Let's also not forget all of the panicking that was unfolding at the time that the pandemic started. We would have experienced another test in 2022 when the account balance would have experienced a $400,000 drop from January 1st of that year through September. Ultimately, all of those losses were regained, and the positive position is one that absolutely would have outperformed the annuity, which, by the way, did exactly what we expected it to do. It's funny, guarantees have a tendency to work that way. So, did we screw up? Should we have advocated for the market? Is the client upset? No. There's another piece of information that I've kind of withheld up until this point. The uniqueness of this individual situation was one where there was a holdings of another position that was quite high risk, but also potentially quite high reward. So it was definitely warranted to talk about options with this rollover that would mitigate risk from a totality of the portfolio standpoint. So yes, you can continue to hold this other position that you have, but maybe by virtue of having that, we should take this other money and put it somewhere with a little bit more safety behind it, just in case this other thing we're pursuing doesn't pan out quite to the degree that you're hoping. Fortunately, in this situation, that other holding did everything that was potentially expected of it and then some, including a plus 40% gain in 2020 that ultimately resulted in shifting the date at which the individual planned to retire forward by a couple of years. So now we have the enviable position of a guaranteed income stream that covers all of the necessities, and this other position that went gangbusters right at the tail end of the accumulation period, allowing for money on hand to far exceed what was ever expected. Now, I know a lot of you are probably listening to this saying, gee, that must be nice, but that's not my situation. And I don't necessarily think you're right about that. You see, while you may not necessarily have the same holdings in this situation, you might be doing things that are a bit riskier than you thought they were. In addition, incorporating some sort of safe accumulation, safe income-generating asset to your portfolio certainly gives you some breathing room to pursue riskier bets with other money that you're holding on to. This is a slightly nuanced perspective on diversification. I do understand that, but it's one that's well worth understanding. I know traditional finance has talked about diversification in the sense of maybe you buy some stocks and maybe you buy some bonds, and therefore you're diversified because stocks and bonds have different rates of return expectations and different risk of loss expectations. While this is true, it's still very difficult to figure out how you would do this, accumulate with it, and then turn it into income. Alternatively, if you own something like an annuity and you know what the income benefit is going to be, or you can model with a much higher degree of precision what that income benefit is going to be, you've got a lot of liberty to pursue riskier things. Maybe stay in a passive indexed investment longer than you thought you were going to, because you have no need to sell your stock position in the S&P 500 and start buying bonds, as an example. Maybe you happen to work for a company that you've got a lot of faith in, and you own a lot of company stock as a result of that. And perhaps you're right that your company will grow in value much faster than the rest of the market as a whole. Or maybe you've made some decisions to make individual stock choices that you've got faith in, and you've got a reason to have that faith. Perhaps you're a Bitcoin person. Whatever it is, there may be something in your portfolio that has high risk and would normally indicate a pullback as you get closer to retirement. But if you start to incorporate other assets that can guarantee income, not so much guarantee against a risk of loss, you will put yourself in a better position to solidify parts of your retirement that you must absolutely have squared away. Once that's done, you can kind of do whatever you want to with the rest of the money. By the way, one of the other things that we looked at that I didn't mention until now was a diversified approach to being in the market. So mixing things up with stocks and bonds, or just going bonds entirely. And we also have the advantage of hindsight now to see how that would have gone. And it turns out those projections were way higher than what actually unfolded. If we had gone all bonds and we look at something like a bond ETF to evaluate the market performance from the inception of this annuity purchase to now, what we find is nearly flat growth. The compound annual growth rate is under 1.5% per year. The income that we likely could produce from that is a pathetic $22.50 per month. Had we split it 50% stocks, 50% bonds, we also end up in a position way below any of our other scenarios. And that's a real life unfolding. This is not hypothetical. This is looking at account balances and looking at the same withdrawal rates. Doing that, we end up with a monthly income of about $3,500, which is several $100s less than our annuity is producing. Let's not forget that the entire time this individual owned this annuity, there was absolute certainty what the income benefit was going to be, because that's how the annuity product in this case works. From the very outset, we knew in any given year what the income amount was. We could look at year 5, we could look at year 6, we could look at year 10, and we knew precisely what we could expect as a guaranteed income amount to withdraw from the contract every month. We also know that this individual cannot outlive this benefit. If the cash value in the annuity goes to zero, that does not matter. The income will continue. So yes, the real unfolding of events from inception to now is a stock market, the S&P 500, outperforming the results that we modeled, and at least at this point, outperforming what the annuity could have produced as a guaranteed income. But the income that we're producing from the S&P 500 result is hypothetical. We don't know that that withdrawal rate is actually safe. We don't know that it would carry through for this individual's entire life. There is absolutely no question about that when it comes to the annuity. There's a number of things we diversified by virtue of this. We diversified against the risk of loss. The annuity wasn't going to lose value. We had diversified against the risk of having to change income. Once we knew what the income amount was, that does not change. But we also diversified complexity here by getting rid of some of it. There are other holdings in this case, and those other holdings have to be managed to a varying degree. But because of the income the annuity produces, there is significant peace of mind in knowing that with a market correction, there's really no need to be massively concerned. First, it was stunning that the annuity could produce income very comparable to a stock market modeled rate of return of 8% net per year over whatever time period we were speculating on. Now, it's even more amazing to watch the calmness unfold for an individual who can live their life, can generate the income that's necessary, and also have plenty of additional money lying around to do fun things. That's true diversification, and that's what people can achieve with annuities. And that's exactly why everyone should at least look them over and find out if it makes sense to put one in their portfolio. Now, I do realize talking about this in the context of income generated by a hypothetical market result and income actually generated by an annuity, and they coming out very close to one another, at least in a modeling scenario, that seems a little remarkable. But I don't really want to make this a don't buy stocks, just buy annuities instead discussion, because I don't think that's a good idea. Ultimately, the takeaway that I want to get across the table here is the idea that annuities bring diversification to the table that's extraordinarily nuanced, but very important because it's diversification of income sources. And I know there's a lot of people out there who are hyper-focused on accumulation because accumulating more money in your retirement account balances makes you feel wealthier, it makes you feel more special. But I promise you a time will come when you realize that account balances don't mean very much. Income that you can produce with your assets is really all that matters once you're retired. And if you can create income, if you can create guaranteed income with your assets, you will feel richer than you ever thought imaginable. Thanks for stopping by. We'll see you next time.